Now, you asked how do we scale blended finance? Srini touched on marginally bankable opportunities. Now, Pentagreen's strategy is very much to provide debt financing to underserved markets in Southeast Asia and South Asia, but assessing investments very much on a commercial risk-return perspective, whilst using blended finance as a funding strategy, right, to bring together the required capital to create that required balance sheet to fund these opportunities. I would say, blended finance certainly is not a silver bullet. It does not work for every opportunity that is unbankable in the market. Some opportunities are just too early stage. They don't have a credible, enough, or even a base revenue model that warrants the use of blended finance. What we focus on is we are very focused on, parts of the market that commercial investors at the moment may view as very difficult to bank, but actually there is a way to bank them. You just have to create the right balance sheet for it. And I would say the word bankable, we like to use that word a lot in the banking space. It's a very relative term. It all depends on the market development and investors and funders' familiarity with a market, with a sector. Some sectors in developed markets were once deemed unbankable or very difficult to bank. Now, with the passage of time, they just become run-of-the-mill transactions. When we look at Southeast Asia, I'll give you an example. Holdco facilities, very well used in developed markets, and certainly very well understood, but very absent in this region. Although, senior debt financing on a project finance basis in this part of the world is much lower than what you will see in DM, right? Which means that Holdco facilities, when you add a senior tranche plus a Holdco facility, you basically get to a senior project finance LTV that you will see in developed markets. Nonetheless, in this region, is something that people are very shy of doing. There's just a lack of financial instruments in this market. Doesn't mean that the asset is unbankable. It simply means that there's nothing available for developers that are looking for that kind of instruments. Another example, assets that are too small, going to the point of fast P. Very often, commercial funders will say, a deal that's below $100 million, I don't have the time to look at it. The return for effort is too low, and then they fall into unbankable bucket, even though actually fundamentally they can be underwritten and they are actually quite bankable, right? So how do you scale blended finance? I think how we think about blended finance and how we use blended finance is when we're looking at funding opportunities, we're also looking at potential growth of the borrowers that we are funding. Can these businesses scale? Do they have a good pipeline? Are they able to realize their pipeline? And in time, can these businesses grow to eventually be funded by the commercial market? That's the ultimate goal. That's on the borrower side. To Jade's point, can blended finance structures eventually go to capital markets? Bayfront is an example. Can private blended finance structures eventually refinance themselves out and optimize via the capital market? And is that potentially a partial, if not full exit for catalytic capital, right? That's another potential. Now, the challenges of blended finance structures certainly are very new. I think the traditional challenge of, having to structure a blended finance is very bespoke. It's asset by asset. It takes donkey years. I think with constructs, an emergence of multifaceted platform level, constructs like the FastP, I think that goes some way to solving that challenge. The main challenge of how do you bring together, different types of capital, how do you meet the requirements of very different capital providers, that is still very real. And I think what's very important is to keep in mind two key principles. One, commercial capital needs a commercial return. That's non-negotiable. They need a commercial return. Catalytic capital needs to see additionality. Catalytic capital is more risk tolerant. They may be willing to accept below market returns, but they want a non-financial return. And so one does need to be able to articulate what that non-financial return is to catalytic capital.